Think about how most people treat a winning investment. The moment it grows big enough to matter, the first question isn't how much is it worth, it's how much will I lose if I sell? Because selling means taxes, and taxes show up instantly. Now take that same situation and stretch it across decades. You put $10,000 into a stock long ago, forget about it, and one day it's worth $10 million. Selling it would create a tax bill so large it changes your decision entirely. So instead of cashing out, you hold. And here's the part most people never learn. If you hold that asset until you die, the tax system effectively wipes the gain off the books. Your heirs inherit it as if it were always worth $10 million, and they can sell it with little to no capital gains tax. This single rule quietly shapes how the wealthy build, spend, and pass on money, and it explains why some fortunes seem to grow untaxed for generations. This rule is called the step-up in basis, and it's one of the most powerful features of the US tax system. On paper, capital gains taxes exist to make sure people pay taxes on investment profits. In practice, those taxes only apply when assets are sold. As long as wealth stays locked inside stocks, businesses, or real estate, it can grow year after year without triggering a tax bill. For everyday investors, this mostly just encourages long-term holding. For the ultra-wealthy, it changes everything. It turns not selling into a full-scale strategy. Instead of asking when to exit, they ask how long they can hold, and how to fund their lives without ever touching the principal. That's where the next piece of the puzzle comes in. If selling triggers taxes, but holding avoids them, how do billionaires actually spend their money? After all, private jets, mansions, security teams, and global travel all cost real cash. The answer is borrowing. When someone owns billions in stock, they don't need to sell it to access money. They can use it as collateral. Banks are more than happy to lend against assets like blue chip stocks because the risk is extremely low. The loans often come with interest rates around 1 to 2%, far lower than what ordinary borrowers ever see. From the bank's perspective, it's one of the safest deals possible. So instead of selling stock and paying capital gains taxes, the wealthy borrow against their holdings. The borrowed money isn't considered income, which means it isn't taxed. On paper, it looks like they earned almost nothing that year. In reality, they might have spent tens or hundreds of millions. The loan can be refinanced, rolled over, or replaced with a new loan. This can continue for decades. And when the person eventually dies, the assets receive that step up in basis. The heirs can sell, pay little or no capital gains tax, and use part of the proceeds to settle any remaining loans. This entire cycle has a name in wealth management circles: buy, borrow, die. This is why you'll sometimes see reports showing billionaires paying shockingly low effective tax rates. It's not that they're hiding money under mattresses or skipping the system, it's that the system taxes income far more aggressively than it taxes wealth. And the wealthiest Americans structure their financial lives so that almost everything they receive shows up as growth, not income. Another major piece of this system shows up on Wall Street in something called carried interest. If you run a hedge fund or private equity firm, your compensation often follows a model known as 2 and 20. You take a 2% management fee on the money you oversee, and then 20% of the profits you generate. That profit share can be enormous, tens of millions or more in a good year. Even though this money is effectively paid for managing other people's investments, the tax code often treats it as a capital gain instead of ordinary income. That means it can be taxed at around 20% instead of the 37% top rate on salaries. The difference adds up fast. If a fund manager earns $10 million through carried interest, they can save roughly $1,700,000 in taxes compared to someone earning the same amount as a salary. Politicians across party lines have criticized this loophole for decades. President Obama once called it the single most egregious provision in the tax code. But despite repeated attempts to close it, intense lobbying from the financial industry has kept it alive. The result is a system where some of the highest earners in the country pay lower rates than professionals making a fraction of their income. Real estate offers another layer of tax advantage, one that's even more accessible to high earners outside Wall Street. The key concept here is depreciation. The tax code assumes that buildings wear out over time, so it allows owners to deduct the cost of a property over a set schedule. Residential rental properties are depreciated over 27.5 years, and commercial buildings over 39 years. The catch is that real estate often increases in market value while it's being depreciated on paper. That creates paper losses. An investor can collect rent, build equity, and see the property's value rise, all while reporting losses on their tax return. Those paper losses can wipe out rental income for tax purposes, and in some cases, even offset other income. This is how someone can appear to lose money year after year while living extremely well. High-profile tax investigations have shown this in action, most famously in reports on Donald Trump's tax returns, where depreciation played a major role in years with minimal federal income tax payments. And when real estate investors eventually sell, they often use another tool to avoid taxes altogether, the 1031 exchange. By reinvesting the proceeds into a new property under specific rules, they can defer capital gains taxes indefinitely. Combined with depreciation, this allows wealth to compound inside real estate portfolios for decades. Beyond domestic strategies, there's also the global dimension. Offshore tax planning allows corporations and wealthy individuals to shift profits to low-tax jurisdictions through legal structures involving subsidiaries, intellectual property, and licensing agreements. Places like the Cayman Islands, Bermuda, and Ireland appear repeatedly because they offer favorable tax treatment. Leaks like the Panama Papers and Paradise Papers exposed how widespread these arrangements are. While not all offshore strategies are illegal, enforcement is difficult due to complexity and secrecy. Estimates suggest that tens of trillions of dollars are held offshore globally, costing governments hundreds of billions in lost tax revenue each year. Charitable foundations introduce another layer that often surprises people. When billionaires donate to their own foundations, they can receive large tax deductions immediately. At the same time, they retain significant influence over how the money is used. Private foundations are generally required to distribute only about 5% of their assets annually, meaning the vast majority can stay invested and grow tax-free. Donating appreciated stock is especially powerful. Someone who donates $10 million in stock they originally bought for $1 million may receive a deduction for the full market value while never paying capital gains tax on the $9 million increase. Philanthropy can do real good, but it also provides major tax and control advantages. Then there are trusts, the tools that allow wealth to move smoothly across generations. Trusts can be designed to reduce or eliminate gift and estate taxes. One popular structure is the Grantor Retained Annuity Trust, or GRAT. In a GRAT, assets are placed into a trust for a short period. The original owner receives payments during that term, and any appreciation above a minimal government-set interest rate passes to heirs tax-free. This strategy becomes incredibly powerful when applied to fast-growing assets like pre-IPO stock. Dynasty trusts go even further, allowing wealth to avoid estate taxes across multiple generations. At this point, money stops behaving like income and starts behaving like engineered infrastructure. Underneath all of these strategies is a simple imbalance. Income from labor is taxed heavily, while income from assets is taxed lightly, or not at all until it's realized. Salaries can be taxed up to 37%. Long-term capital gains max out far lower. This is why Warren Buffett famously said he paid a lower tax rate than his secretary. And it's why investigations have found that the richest Americans often pay effective tax rates in the low single digits when measured against their true increases in wealth. There are even more obscure tools, like private placement life insurance, which allows ultra-wealthy individuals to invest millions inside specialized insurance policies where growth can be sheltered from taxes. These strategies are completely legal, but inaccessible to most people due to high minimums and complexity. Opportunity zones, introduced to encourage investment in distressed communities, have also become tax shelters for wealthy investors, often benefiting luxury developments more than local residents. All of this leads to a hard truth. The tax system isn't just about fairness or hard work. It's about structure. People with enough assets don't earn their lifestyle through paychecks. They finance it through ownership. They borrow instead of selling. They plan across decades instead of years. And when the final transfer happens, the step up in basis quietly resets the scoreboard. So the takeaway isn't outrage, it's awareness. Understanding how the system works changes how you think about money. You start paying attention to assets, long-term ownership, and how different types of income are treated. You may never use these strategies at their extreme levels, but seeing the playbook explains why the richest Americans seem to play by different rules. And once you understand those rules, you stop being confused by the headlines. You start seeing the system for what it is, and planning accordingly. If this helped you see the system more clearly, subscribe here. We break down how money actually works, without the noise, the hype, or the shortcuts, so you can make smarter decisions over time.